Hello and welcome. My name is Mr. J.M. Kimani. You are lecturer in Management Accounting. Welcome to Lesson 6 of Budgeting and Budgetary Controls. Now, Lesson 6 will focus on the original or fixed budget as well as the flexible budget. Now, talking of the fixed budget and original budget, I had explained in lesson 1 that when it comes to fixed budget is that budget that you prepare and remain like that for the whole period. But when it comes to the the flexible budget, it's a budget that is prepared with respect to the actual level of performance or actual level of production. That it is just the original budget, but having, let's say, having prorated either downwards or let's say upwards, depending with the actual production. So it is the same original budget, but we try to get the duplicate of that, but at a lesser or at a higher volume. Normally, we say when it comes to flexible budget that we require to compare apple to apple, but not things which are not related. So we want to compare not a budget of 20,000 units and the actual statement of like say 15,000 units. Those are not comparable. We would want to tone down our original budget maybe of 20,000 to let's say a 15,000 level, just like the actuals. That now it become apple to apple comparison. That is actually the spirit concerning the flexible budget. The only problem is that this flexible budget is prepared at the end of the period, having obtained the actual level of production. So that is the only problem, although you prepare with the conditions that were prevailing at the time of preparing the original budget. So if it was known in advance, it would have been the original budget is still the flexible budget if the actual production is the same as the budget production. But it's because of the difference in production budgeted and actual that we come up with the flexible budget. In some cases, a company can prepare several budgets for different levels of production. Let's say a budget for 20,000, a budget for 15,000, a budget for maybe 10,000. And as long as we are going to operate at any of the three levels, then of course we'll be having an original budget and compared with the actual, because the original budget available with the actual, they are comparable. Otherwise, if you have only one budget, you end up preparing a flexible budget. So we'll discuss more. Let's have a question. And this question reads that, Ujuzi Limited operates a standard marginal cost accounting system. The information relating to product Exa, which is manufactured in one of the company's departments, is given below. Standard marginal cost per unit in shillings. Direct materials 6 kgs at shillings 40 per kg, which is 240 shillings per unit. Direct labor, which is 1 hour at shillings 70 per hour, that is 70 shillings per unit. Variable production overheads is 30 shillings per unit. Total marginal cost per unit is 340 shillings. Additional information number 1, variable production overheads vary with units produced. Number 2, budgeted fixed production overheads per month amounted to shillings 1 million. Number 3, budgeted production for the product Exa amounted to 20,000 units per month. Number 4, budgeted selling price per unit amounted to shillings 440. Number 5, the actual results for the month of April 2016 were as follows. We have units of Exa produced 18,500. Direct materials purchased and used 113,500 kgs for the amount of 4,426,500. Direct labor 17,800 hours, 1,299,400. Variable production overheads incurred 588,000. Fixed production overheads incurred is 1,040,000. Total of the actual cost is 7,353,900. Actual selling price per unit is shillings 480. Required, prepare in columnar format the original budget flexed budget, and actual profit statement. So you prepare those budgets and actual statement. So in our preparation, you're going to have this. This is actually the income statement. Income statement. So here we're having the details. We are having the original budget. We are having the flexed budget. We are having also the actual, and we also include the variance for comparison purpose. I would want to also do the variance here just because of comparison purpose. Otherwise, variance analysis we shall do in the next topic, which is standard costing. But for now, I just want to have a comparison, and anytime you're comparing the original or either the budget and the actual, that difference you get is what we refer to as variance. So we do have, these are the details. This original budget, this is the flexible budget, this is the actual budget, because the actual statement we don't require, we have been given the information about the cost. So we don't require to have a lot of calculation in terms of cost. Then you have the variance here. Now, let's see. We shall begin with the sales. The original budget is based on what we had planned at the beginning, which we had planned 20,000. 20,000 has been given in the information number 3. 20,000 units, each at information number 4, 440. This is going to give us 800, which is 8,800,000. Flexed budget. The flexed budget capacity or volume is the same as the actual, and therefore the actual level of production and sale information number 5 is 18,500, but it must be at the same budget cost or a budget profit price of 440. So should we multiply this? We get 18,500 as the actual level of production. We multiply by the 440 as the budget price. Our income will be 18,500 times 440. That is 8,140,000. This 8,140,000. Remember, if you can be able to know the flexible multiplier, there is a multiplier or a factor we can use. Like now we say that the actual is 18,500 divided by the 20,000, which is actually 0.925. That means we produced and we operated at 92.5% of the original expectation. That means we can take this budget the way it is. Everything we multiply by 92.5%. Should we multiply this one by 92.5%? This is 8,800. This is giving us 8,140. That is how the flexible budget is. So we are flexing. We are prorating the original budget at that level of actual production. But in actual sense, we sold 18,500 at 480. That is actually the actual sales in units and in price. 18,500 multiplied by 480. This is giving us 880,000. 880,000. Now, This variance column is just to understand the difference between what we expected for that level of 18,500 and the actual for the same level of 18,500. This is what we call apple to apple. So when you're comparing these two, this is now apple. This is apple to apple comparison. We are comparing apple to apple. So this will be 8140 minus 8880. That means we made some 740,000 favorable variance. Why favorable? We made more money. These are sales, income. 8.8 is more than 8.1, and that is the best comparison. And like when you compare 8.8 million original budget and the 8.8, that we say that somehow we have only an 80,000 difference. 80,000 is on the lower side and actually is a poor comparison. We don't compare the original budget and the actual if the level of production are different. We have to prepare the flexible budget. But if, for example, we produced the same 20,000, we don't require the flexible budget. We would have the original and the actual compared. Anyway, that's all about sales. We have less cost, so we have less costs. So the cost here, we do have the direct material cost. So first of all, I would want to have, and I do for you, about the direct materials quantity. I do for you the quantity first. The quantity that we were expected to use, so that at least we know what is original and what is flexible. We were, if you look at the budget, the standard cost up there, standard cost card, direct materials were 6 kgs per unit, meaning we were to produce 20,000 units and each unit takes 6 kgs. This is 120,000 kgs that we are budgeting, and therefore this is, I'm double-lining because it was just mere information. But when you come to the material cost, so direct material cost, we take the 120,000 kgs. Each we were to spend how much as per the budget? We were to spend 40 shillings. And therefore this is going to give us the 4,800,000 as our, this is 4,800,000 as our cost. So I've shown you first of all the budgeted quantity, and I have now the budget cost of 4.8 million. Then I have the flexible budget. To produce 18,500 and we need 6 kgs. This is going to give us how much required quantity. So this is going to give us 18,500 multiplied by 6. This is 111,000 kgs. We double line that. But the cost will be 111,000 kgs each at 40 shillings, which is actually 4,440,000. 4,040,000 as actually the material cost. But the actual given in note number 5, the direct materials used are 113,500 kgs. This is 113,500 kgs. We double line because that is just mere supply of information. But the cost involved, how much do you spend? You don't require to multiply. We have been given the cost of 4,426,500. So we have 4,426,500. And as we do the comparison, we understand that we should have spent 4.4 million, but we spent 4.426. Therefore, we saved. How much is this? So this is 4,440 minus 4426.5. So this is actually a 13,500 favorable. Now this is where the flexible budget gets meaning. That as you're comparing what we should have spent on 4.4 and this is 4.426, you have a saving. But if you're to compare the original budget of 4.8 and this is a 4.4, you think you have a very big saving. But remember, this is for the original budget of 20,000. This is the actual for 18. Automatically, we must have a difference. But for these two now, we can be able to compare and we make some analysis there. Then when it comes to the direct labor, direct labor cost, direct labor first of all, labor hours. We, as per the budget, we were to use 1 hour. If you look at the budget up there, we were to use 1 hour. So therefore, for 20,000 units multiplied by 1 hour, that means it's 20,000 hours. That is double line to show that we already have now the 20,000 hours as budgeted. And this now the direct labor cost. It is 20,000 hours. Each hour was 70 shillings as recorded in the budget. We were to spend 70 shillings. So therefore 20 times 70, this would give us 1,400,000. 1,400,000 as a cost. Then when it comes to the flexible, we were to produce 18,500 times 1 hour. So that now we can have 18,500 hours. This is the budget number of hours we were to use for the 18,500 units of production. So these 18,500 hours, we multiply by 70 shillings as our budget cost. So 18,500 multiplied by 70 per hour, this is 1,295,000. 1,295,000. But actually, how many hours did we use? In the note number 5, we used 17,800 hours. 17,800 hours to do the production. But the cost spent is 12,99,400. We spent a cost of 12,99,400, which is 1,299,400. So the comparison shall be, we were to spend 12,95,000, but actually we have spent 12,99,400. That means we have overspent by an amount of 4,400, which is adverse. Again, look at it, that we have spent more than expected. So it is actually an adverse. But supposing you were to compare the original budget of 1.4 and this is 1.2, you would have been happy that you have made a saving. But remember, it's because you produce less. Well, that one was a higher level of production. So that's a bad comparison, but the best is where you compare the flexible and the actual. Then there is the variable production overheads. Variable production overheads. This we have been told that we use the information number 1, that the variable production overheads vary with units produced. So if you do 20,000 units, each at 30 shillings provided in that cost statement or the standard cost card, that means we have to use 600,000. This is 600,000 the cost that you are to spend as per the budget. But the flexible budget, we were to produce 18,500, but now at 30 shillings. How much money is this that we have to spend? 18,500 multiplied by 30 shillings. This is actually 555,000. 555,000. That's what we should have spent. But how much do we spend? Actually, in note number 5, we spent a total of 588,000. 588,000. That as we are doing the comparison, we compare the 555 minus the 588. That tells us we have overspent by 33,000. This is 33,000, which is adverse. And that is a good comparison. And like if you were to compare the 600 and the 588, we would have thought that we have made a saving of 12,000. But remember, that saving is because we have produced less. So it's normal, it's known. But when you compare these two now, you are able to make some either analysis and do some investigation what may have happened. That for the same level of production, you used more hours or more cost than expected. Then the last one is the fixed production overheads that you have been given in note number, I think number 2. Number 2 says that the budgeted fixed production is 1 million. So we have 1 million here. The fixed cost is 1 million. But remember and note something here that when you are talking of a fixed cost, it does not depend on the volume. Whether the volume is higher or lower, the fixed cost is 1 million. And therefore, even if we were to budget for 18,500 units, still the cost or the fixed cost would have been 1 million. We do not flex the fixed cost. We don't flex fixed cost, they remain the same. But the actual cost spent in note number 5 is 1,040,000. So 1,040,000. Now that tells you that you have spent 40,000 over and above. is adverse. So we compare that way. So note that we don't flex the fixed cost like we have done for the variable and the rest. So it's only these fixed costs that you don't change. Otherwise, the rest we can just multiply by, remember I told you that we have operated at 92.5%. So everything here you can multiply by 92.5% apart from the fixed that you don't vary. And therefore, that is the point. That's all about the items of cost. And we can now subtract to get the profit. You can subtract that you can get the net profit. So this is a net profit. So as per the original budget, a net profit shall be taking the revenue of 8,800. You subtract this 4,800. Subtract this 1,400, subtract 600, and subtract 1,000. This is 1,000 remaining, as in 1 million remaining. So this is 1 million profit that we were budgeting to realize. But the flexible budget for the level of production of 18,500, 8140, you subtract 440. You subtract 1295. You subtract there is 555, and there is 1 million. This is giving us 850,000. That is what we have realized, or we are to realize. But the actual amount realized shall be the 880. You subtract the 4426.5. You subtract the 1299.4. You subtract the 588 and the 1040. That is giving us 1,526,100. 1,526,100. And if you make a comparison of this 850,000 minus the 1526, you make actually an increment of 676,100. And this, when you look at it keenly, even if you add the favorables and adverses, the 740, the plus 13.5, the minus 4.4, the minus 33, and the minus 40, this is giving you the same 676,100 favorable. Is favorable because you have made more profit than expected. More profit than expected. And that is the position. That's how we prepare the original budget, which is a fixed budget, the flexible budget, and the actual, and we make a comparison. I would want also to go further and explain about a reconciliation of the flexible budget and the actual. So you can have here reconciliation of flexed budget profit with actual profit. So this is comparing apple to apple, and you are now comparing the results. Why the results changed. So we normally start with the profit, actual profit. Actual profit that has been realized is 1,526,100. That's the actual profit. Then in your explanation, what may have happened in the course of your execution of the budget is that you may have encountered adverses. Adverse variants are just the bottlenecks that made you make less profit, that they were not envisaged when you are preparing the original the budget. So since we are not there, we need to add here. We say add adverse variances. These happenings, they were not envisaged when you are preparing the budget. So therefore, you need to add these adverses, like we have the direct labor cost, which is 4,400. You add the variable production overhead cost, which is 33,000. and you do have the fixed production overhead cost, which is 40,000. Now this, when you add, they are giving us 77. This is 77,400. So were it not for this 77,400, we would have made more money. So this is what we never predicted and envisaged during the time of budget. Then we less because we also did not predict that we are going to have some favorables. We never predicted and preempted that when it comes to the budget period and start executing the budget, we are going to have this kind of advantages, this kind of advantages. So we're going to have the favorables, so less favorable variances. So of we have how much? We have this is the sales, which is 740,000, and you have the other one is direct material cost. So this is 13,500. That when you add this, we get 753. Sorry, we get we write it here, 753,500. This we are subtracting. So when you do the subtraction, we are going to get this figure, which is 850. Let's see. We have 15,26,100. We add 77,400. We less 753,500. This is giving us 850. 850,000. That is what? The flexed budget profit. So we have seen how we can even reconcile this actual and the budget and the flexed budget profits. So that is one of the ways we can prepare the flexible budget using the units. We can use the units and make a comparison. But at the same time, we can also use the percentages where you operate at this percent and this percent. We want to know how the cost can be flexed and we prepare a budget. Now, we can try another example where we are going to look at the flexible budget as follows. This is December 2013. Question 3 part B. December 2013 question 3 part B. The question reads that Kazuri Furniture manufactures a single product branded sofa. The following were the budgeted cost at different levels of output for the year ended 31st of December 2013. You are given output in units. We have units of 30,000, 33,000, and even 36,000. The amount, materials, 900,000, 990,000, and 1080,000. Wages, 750,000, 825,000, and 900,000. We have depreciation, 240,000, 240,000, and 240,000. Power is 510,000, 540,000, and 570,000. Then salaries, 510,000, 510,000, and 510,000. So total 2910,000, 3105,000, and 300,000. Required a flexible budget for the year ended 1st of December 2013 if the actual production for the year turns out to be 34,800 units. End of question. Now this question, you have been given several budgets. You have been given the budget for 30,000, 33,000, and 36,000. This is what I was telling you, that should you have such kind of budgets and it happened that your actual production is any of the three, then you don't need to prepare a flexible budget. Already that original budget becomes the flexible budget. But unfortunately for this company, even after having the three budgets, the actual level of production did not fit any of the three. So it is actually different number of units. So we require to determine this. And therefore, when you are flexing, as we saw here, the variables the variables, they are able to differ. You're able to vary them. But the fixed one, you cannot differ. You cannot vary it. It's going to remain constant. So it was simple for this one that we knew these are variables, but this one is fixed. But here you have been given some cost. This cost, you can't tell whether they are variable or they are fixed. And because of that, we require to devise a method of separating the variable cost from the fixed cost. And we either use what you call the high-low method or the regression method or regression analysis. Now, for regression, it's going to be tedious, but at the same time, we are going to have for each and every item of cost. So it's a lot of cost, a lot of work, plus also lack of enough data. So the best one we use is the high-low method, where we take the two levels of production and we are able to use that to separate the fixed from the variable cost. Now, the solution for this will be using this formula of the cost estimation. We have done cost estimation previously in our earlier topics. So we'll have as follows. We have total cost equals to fixed cost plus variable cost. So this is like y equals to a plus b x. So b is a change in y over change in x, which in our case, y is a total cost, while the x is going to be our number of units. So we choose the 30,000 and the 36,000. So that to be the lower and that 6 to be the higher. So that means we can say, like if we do for the material cost, this is materials. When I say B, we can look at the change in cost. We take the cost of that 6,000, which to be the highest, so it's 1080,000. We subtract the cost of 30,000, which is 900,000. Then you divide by that difference in higher and lower, that 6,000 units minus 30,000. This is going to give us B, which is the change. So remember, this B, I am determining it as the rate of change or the slope. And I have chosen the higher and the lower. I do not consider the mid-level of 33,000. So this will be enough and will give us what we want. So the numerator is 1080,000, while minus 900 anyway. Then I divide by the denominator, which is actually a difference of 6,000. So divided by 6. This will give us 30. When we get that, we now substitute in the first. We can just look at this 1080. You can see that therefore, 1080 is my y equals to a plus 30 is my b. Then x is my that 6,000. So my a is the difference. If you transfer this that times that 6, which if I multiply by that 6, I'm getting actually 1080. If I subtract 1080, I get a 0. That means that my y is only 30 x. There is no a, meaning the materials is purely so entirely variable. The material cost is entirely variable. There is no fixed element. Now, this point of substituting one of these two categories, even if you substitute this 930, you'll have 900 here, you'll have 30 here. 30 times 30, you get 900. Subtract from 900, you get 0. So it does not matter which one, but you must use one of these two. Then we come to number 2. Number 2 is the wages. We have wages. And for wages, B shall be the change. The cost here is 900,000 minus 750. This we divide by that 6,000 minus 30,000. This is constant. It does not change. The level does not change. So this will give us a value of the numerator is 900 minus 750, which is 150, divided by 6,000. This gives us 25. Then you say that therefore 900 being my y equals to a plus 25 in bracket that 6,000 being my x. So my a shall be the difference between 900 and this answer, which if I multiply by that 6, I get the same 900. That means again I have a as what? 0. I have a. I have a as 0. So that means we have my y as 25x. Again, that tells us that the whole of this is entirely variable. That's all about the 2. Then the next one, which is number 3. Number 3 is actually what? Number 3 is depreciation. Now, depreciation, there is no change. All the levels of production, 30, 33, and 36, there is no change. So therefore, the whole of this is a fixed cost. This is fixed cost, or either you can have entirely fixed because it's not changing. You can have this is entirely fixed. It's not changing. Number 4. I have number 4 as power. So the power B, I can have the change in cost, which is actually 570,000. 570,000 minus the other one is 510,000. I divide by actually that 6,000 units and 30,000 as the two levels we are comparing. And this one, as we determine the rate of change, which is now the variable element. So we'll have it as the numerator is 570 minus 510, which is 60,000. You divide by 6,000. This is actually giving us 10. So you see that therefore 570 as my y equals to a plus 10 in bracket, that's 6,000 as my x. So my y, my a is the difference between 570 minus the 360. This is giving us to 10. So therefore that y equals to 10,000 plus 10x. That tells you that this power is a mixed cost. A mixed cost of fixed cost of 210 and the variable element of 10 per unit. Then number 5, lastly, is the salaries. We have salaries. Looking at salaries, there is no change. All the levels of production are the same cost, 510, 510. So this one is entirely fixed. There's no change. And having understood that is a composition, then when you're told to come up with a flexible budget for the number of units, we can have it here. This is now flexible budget. So this budget is for how many units? And remember something, we have not been given the actual costs. We have only been given the actual operating level, which is a total of, this is 34,800 for 34,800 units. This is the budget we are preparing using the budget information which we have, but we don't have the actual cost so that you can compare. But the other one, we had the actual cost we were to compare and get the adverse or favorable. So starting with the material cost, the cost per unit is 30 shillings. So you're going to have here 34,800 each at 30 shillings. So this is going to give us a total of 34,800 multiplied by 30. This is giving us 1,044,000. Then we have the next one is wages. Wages cost, again, it was variable entirely. So it is actually 34,800, each at 25. So 34,800 at 25. This is giving us 870,000. And you can note that 34,800 is in between 30 and 36. No wonder the cost we are getting is also in between 1080 and 900, and then 900 and 750. We are getting that. Then you have the number 3 is depreciation. Depreciation, this one is a fixed cost. It does not change, is constant, it does not flex. So the depreciation given there is an amount of how much? Is it 240,000? Yeah. So you have 240,000, is not changing irrespective of the units. Then you have power. Now power, we have the variable, which is 34,800, each at 10. And you have the fixed element, fixed cost, which is not changing. So this is actually going to give us 348,000, while the fixed element is this 210,000, 210. That will never change, will always be that unless otherwise. Then lastly, we have the salaries. Salaries also is fixed. This is a fixed cost. It shall remain to be, is it 510? Shall remain to be 510. 510. And therefore, coming up with the cost of 34,800 units, we need to add. So we have 10s 44 plus 870 plus 240 plus 348 plus 210 plus 510. This is giving us 3,222,000. This is the budget cost. So the budget cost for these 34,800 units are actually 3.222 million, which is lower than the cost of that 6,000, which must make sense. And that's all about the question. Now we have come to the end of a flexible budget, how it is computed, and we have even shown you how we compare with the actual statement, and we make that comparison to get the variances, and also the reconciliation of that budgeted or the flexible budget profit and the actual profit. So that is it as per that lesson. And Gbet, now you have understood what is an original budget or fixed budget and the flexible budget. So with that, we've come to the end, and I wish you all the best as you make more practice and have more understanding concerning these budgets. Now, in our lesson 7, we are going to wind up this topic of budgeting with issues concerning the other types of budgets like the ZBB and just a bit of ABB budget. So with that, that is it. Thank you and all the best.